Are you a better investor than Warren Buffett? Unless you're the most arrogant person on the face of the earth, your answer is probably not. However, there is a magic formula that supposedly will help you earn better than Buffett investment returns. In this video, we're going to talk about it.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
A few weeks ago, I got a question from Jeff asking if I could do a review of Joel Greenblatt's The Little Book That Beats the Market. He says, I know it's not magic, but does it work? So in this video, we're going to look at 3 of my biggest takeaways from The Little Book That Beats the Market. Can a simple formula really beat the market by over 10% per year? Which, by the way, would put you right on par with Warren Buffett if it could actually do that. We'll look at what this magic formula is and how it's calculated. Then I'll show you my own back test going back to 2000 all the way to 2021. Can I replicate the results that Greenblatt got in his own back test? And then at the end of the video, I'll show you the current top 30 stocks ranked by the magic formula score. And I'll give you a couple of thoughts on that list, including a few ways we might be able to improve it. My first takeaway from the book was that discipline is key. Greenblatt says that having a disciplined, methodical, long-term investment strategy is essential to making it through and being successful in almost any market environment. But here's the key part. He says it can't just make sense, it must make sense to you. Having a deep understanding is the only way to stick with a long-term strategy that might not work over shorter time periods. This is a huge part of the book. He talks about how the magic formula in his back test worked really well over the entire time period. However, there were pockets of 2, even 3-year periods where it performed terribly. So if you're going to make it through those periods without giving up on what appears to be a good strategy, you're going to have to believe in it in your very bones. So I think that's key for this particular strategy, or anything really. If you do not have very strong conviction in a strategy or a stock that you're buying, you're not going to stick with it in the bad times. That is absolutely critical for you. Whether you buy leveraged ETFs or Bitcoin or covered calls or whatever you're buying, you have to believe in it 100%. The second takeaway from this book is that basically most investors would do better following a simple formula and applying that formula the same way over time instead of doing in-depth analysis. Greenblatt quotes Benjamin Graham several points in the book, and he talks about how Ben Graham, who is the father of value investing and really the mentor of Warren Buffett, he talked about how most individual investors and even many professional investors would have a hard time making the types of predictions and analysis necessary to value and invest in businesses on their own. The crux of this argument is really behavioral. If you follow a formula and you just stick with the formula year in, year out, you're probably going to have decent investment results. If, on the other hand, you're trying to go in and say, well, I don't like that business because of XYZ reason, or, well, I don't like that stock because the price has been going down for the last year, those are more likely to be bad results than good results. Your emotions are going to get in the way of you making sound investment choices, whereas if you just follow the formula, you're likely to have at least decent results. Ben Graham himself even followed his own investment formula, and he advocated it before his death. He said if you could buy a group of 20 or 30 stocks that were cheap enough to meet the requirements of his particular formula, you don't need to do any further research, yet the results should be quite satisfactory. Graham does have a formula. You can look it up online. I may even do a video on it sometime. The problem is that Graham's formula is extremely strict, and there are basically no stocks or very few stocks that actually meet his criteria today. So it's difficult to apply what Graham used to do back in the 40s and 50s. So Greenblatt basically took the idea that Graham had of coming up with an investment formula, and he made it his own. So the focus is on both good companies and good prices, which is basically what Buffett has done for decades. And the results of following this strategy, at least in the backtest, are extraordinary. And that is my takeaway number 3, which is the backtested results, at least, are indeed magical. In the book, Greenblatt says that from 1988 to 2004, a portfolio of approximately 30 stocks with the best combination of return on capital and high earnings yield, we'll talk more on those in a second, would have returned approximately 30.8% per year. If you compare that to the S&P 500, only returned 12.3% per year. Again, these results would be better than Warren Buffett's, which is truly an extraordinary claim. If you were able to achieve that, an $11,000 investment would grow to over $1 million, compared to an S&P 500 investment would have grown the same to $79,000. The question I wanted to answer was, does that actually work? Can I replicate Greenblatt's impressive results on my own? But before we get into that, let's talk about how exactly the magic formula works. Greenblatt took all available United States stocks and he ranked them by the highest earnings yield, which he defined as operating income or EBIT over enterprise value, which is a variation of market cap that includes more of the balance sheet items. But in effect, this is a low PE type thinking. So essentially, the cheapest stocks get the lowest score, whereas the most expensive stocks get the highest score. The other part of the ranking is return on capital, which he used EBIT divided by the net plant and equipment plus accounts receivable plus inventory for each of the stocks. And again, the company with the highest return on capital gets a score of 1, and the lowest gets a score of 3,500. And then he would simply add the scores up. To illustrate, let's use a hypothetical example. I've replaced EBIT to EV with PE just for illustration purposes. Let's say Apple currently trades at a trailing 12-month PE of 31.4 and a trailing 12-month return on capital of 51.7%. Both of those are from Morningstar. This would be a little bit higher than the market's average, so we'll say it gets a score of 2,000 for this one. The return on invested capital of over 50% is absolutely sensational, so Apple would probably be, let's say, in the top 100 on this score. I'm just making these numbers up just to illustrate. So Apple's score here would be 2,100. Simply add those up. Let's compare that with AT&T. It currently trades at a trailing 12-month PE of 191, which is obviously extremely high, so it would probably rank at least, say, 3,000. Its trailing 12-month return on capital was 1.7, which again is probably close to the bottom of the list, so we'll say this is at 2,500. So if we add these up, we come up with 5,500. So in this particular case, if we were ranking just two stocks, Apple would be the top rank and AT&T would be number 2. Of course, in our example here, and what Greenblatt's doing is ranking all 3,500 stocks by this metric, and then simply taking what are the top 30 stocks. So maybe the number 1 overall stock has a score of 25. When you add these two numbers together, that might be number 1. Number 2 might have a score of, say, 40, and so on and so forth. So does this actually work as well as Greenblatt suggests that it could? I just did my own backtest. I'm not going to claim to do it just the same exact way that Greenblatt did. I tried to do it as closely as I possibly could. Here was my methodology. I did all US stocks, and I actually also did a few other variations of this, which I'll show you in a second. I ranked by the highest EBIT to EV yield using the same calculation that Greenblatt described in the book, as well as the same return on capital calculation. And then I took the top 30 stocks for any company that had a operating income of less than 0, basically negative earnings, or they didn't have data. I excluded those stocks. Greenblatt's backtest was from 1988 to 2004. Mine was from January of 2001 through December of 2021. That's as much data as I had to work with. I held each of these portfolio for a full year. I ran these back tests using several different variations of a starting universe. The first one was all stocks in the United States, excluding those that are trading on over-the-counter. So basically, they're not listed on a major US stock exchange. If I backtest the magic formula on this universe, I came up with an annualized total return of 12.51% per year. The equal weight S&P 500 returned 8.4. I used the equal weight S&P because in this case, we're equal weighting all 30 stocks. So it's more fair to compare that to the equal weighted S&P instead of the regular S&P, which is weighted by market cap. So the magic formula did indeed outperform the market by a little bit over 4% per year. However, that was nowhere close to the results he claimed from 88 to 2004. It also had a maximum drawdown of negative 62.7%, which compares to the S&P 500 equal weight at minus 60. The standard deviation, in other words, how much the strategy moved up and down from year to year, was 22.2 compared with the S&P 500 at 17.2. So this is a higher return strategy. However, you can see that the risks are also quite a bit higher for following this particular strategy. So while these results are pretty good, I would say overall they're not nearly as good as what Greenblatt seems to suggest. I also tried this out on the Russell 3000. Using this universe, the results got a little bit worse. I got 11.2% per year. Our maximum drawdown and standard deviation numbers both improved, which we would expect since this is a larger universe of bigger companies. It should be a little bit higher quality. However, the annual outperformance of just over 2.5% per year is not all that impressive, considering you are still taking a little bit higher risk to get that. Another universe that I tried was the S&P 1500. So this is basically the combination of the S&P 500 as well as S&P's 600 small cap index and the S&P 400 mid cap index. The results here were a little bit better than the Russell, but still I was not able to replicate Greenblatt's results. The annualized outperformance was a little bit over 3% per year on alpha, with a max drawdown of 65% and a standard deviation of 19.7. However, whenever I applied this formula to the S&P 500, the results actually got quite a bit better. The S&P 500 produced an annualized return of 13.8%. Once again, that's not quite as good as advertised, but we are getting into large cap stocks. And you can also see that the consistency of the outperformance definitely improves. You can see this by the ever widening gap between the screener, which is the red line, and the S&P 500, which is the blue line. The maximum drawdown was improved as well at just under 60%, and the standard deviation was substantially improved at 18%. If you're interested in running these results on your own, you can check out Portfolio 123. I think they have a trial for $9 and you can get the backtester for 3 weeks. You can simulate some of these strategies on your own. I'll put a link to that in the description below. Now let's take a look at the top 30 stocks in the S&P 500 ranked by the magic formula. I've also included some key metrics, and I just wanted to spend a couple minutes going through these because I think there's some ways we might be able to improve the results of the magic formula by just considering a few of these items. The first is the magic formula only considers return on investment, which is in this particular column. However, there are some industries that naturally have higher return on invested capital than others. For example, if you look at the pharmaceutical industry, you'll see pretty impressive results across the board. What we're really looking for is a company that has a return on invested capital greater than its peers and its industry. That really tells us which of those companies has a competitive advantage and which do not. And we can see how a business compares with its broader industry by looking at this column. This tells us what the return on invested capital was compared with the industry as a whole. So, for example, Gilead Sciences at 17% is pretty impressive on its own, but compared with the industry that it operates in, it was 51% less than the overall industry. We also see that the 5-year average return on capital for Gilead was 14%, whereas the rest of the industry did a whole lot better than them. 80% less return on capital compared with the industry. We also see the same things for the other numbers in red. So Hologic and Moderna both lagged the industry substantially. We see the same with Altria, Activision, Regeneron, Norton LifeLock, Organon, Philip Morris, AbbVie, and Oracle. So that doesn't necessarily mean these are bad stocks. It's just suggesting that the return on invested capital that they're posting may be more of a function of the industry that they're operating in and less of a function of them actually having a competitive advantage. So that may be something to look at a little bit further. The other item I wanted to point out here was the price to earnings ratio. Greenblatt used EBIT to EV in his calculation, but just for illustration purposes, I've pulled in here the trailing 12-month price to earnings ratio for each stock, as well as the next fiscal year PE, so the forward PE. And I've highlighted in red the stocks that have a higher PE next year than this year. In other words, the earnings are expected to decrease next year compared to this year. Obviously, any company with decreasing earnings is probably not one that you want to look at. And even if it's showing up as a good value based on today's PE, if the earnings are steadily dropping over time, that's definitely something you want to consider. It may not be as good of a value as you think. So we see that several stocks here have a PE expected to go up based on decreasing earnings. Bath & Body Works is a new name, so is Dish Network, Quest Diagnostics. We see Regeneron, again, also had lower returns on capital than its peers. Laboratory Holdings, Organon, again, shows up there. eBay, and Viacom. So those are definitely areas to watch out for. The other area you might take a look at is this metric, which is the price relative to the free cash flow over the last 12 months. And what I'm looking at here is any company that has a substantially higher price to free cash flow than price to earnings. In other words, the free cash flow numbers are much lower than the earnings per share that they are reporting. So for example, Altria trades at a price to free cash flow ratio of nearly 50 compared with a forward PE of 10. So that's definitely something to watch out for. They also have a dividend yield of over 7.7%. A high dividend yield may look good at the beginning. However, it's suggesting that the market expects this business to cut its dividend at some point in the future. That's not likely sustainable, at least not from what the market thinks. So those are definitely two red flags on Altria. Western Union also has a yield over 5%. 6 other stocks had a price to free cash flow over 30, including Viacom, Philip Morris, BlackRock, ICE, Oracle, and Kraft Heinz. I think there are some ways that you might be able to improve the results of the magic formula just by considering a couple of these other variables. I may try to run some more tests on these just to see if there's anything that I might be able to do to make the results even better, considering some of these additional metrics. And that's not to say anything actually shows up, but it may be interesting. So let me know in the comment section if that's something you'd want to see. If there are any other variables or any other stock systems that you've seen and you're interested in seeing the tests on those, let me know in the comment section down below. If you're interested in why Greenblatt and why I think Buffett looks at high return on capital companies more than any other, check out this next video where I explain why I think this is the single best metric for determining whether a stock has a competitive advantage or not.